Good morning and welcome to Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. For this episode, we're going to look at retirement income strategies and Social Security. And helping me do that is Pfau. He's the Director of Retirement Research at McLean Asset Management. And we also have our good friend Irv Rosenzweig. He's the Chief Investment Officer over at RZWealth. Thank you both of us for joining us live in MarketSite. Now, you're new to us, Wade, so give us a little bit of your background and what's going on over at McLean.
Yeah, thanks, Jill. So McLean is an RIA firm based in McLean, Virginia, and I operate the Retirement Researcher website. So that's a big part of McLean really building out the retirement income area. I'm also a professor of retirement income at the American College in Bryn Mawr, Pennsylvania. So I'm really focused on what happens when you get to retirement to make sure your assets will be sustainable for as long as you live.
All right, Irv, real quick, tell us about RZWealth.
RZWealth, it's an RIA firm outside of Philadelphia. We're aligned with Carson Group, who's an $8.6 billion assets under advisement company. Been doing this over 30 years. Big responsibility, but I enjoy it, and we're entering our third generation of clients right now, so it's an exciting time for us.
All right, well, let's get right into this and talk about retirement income strategies. And everyone, I just want to show you Wade's new book, How Much Can I Spend in Retirement? And what we're going to focus on here is managing sequence risk. So the question, Wade, is retirement income planning, is that different from traditional investments?
Mm-hmm. Yeah, absolutely. That's really now, retirement income has evolved to become a distinct field in financial planning. And it's mainly due to the changing nature of risk, that retirees' lifestyles become more vulnerable to a stock market downturn. Prior to retirement, it's easier to recover, but post-retirement, it's really a set of three major risks. The longevity risk, not knowing how long you need to plan for. The market risk and how that gets further amplified by when you take distributions from your assets. It just, volatility has a bigger impact. And then also spending shocks, the things outside of the baseline budget that you need to have liquidity to be prepared for long-term care, health care, and so forth.
So, Irv, as an RIA, how do you set people up for retirement planning? People are living longer these days. We just went through a crash less than 10 years ago,
right.
And that has impacted people's portfolio and spending ability.
It's difficult. They're still operating in history, as far as higher rates of interest and things like that, and maybe not in control or having a budget of their finances. A lot of people, that's the biggest problem, honestly, is getting people to do the prep for me so I have a better sense of what amount of money they're spending so I can better plan for them. Because they ask me, can I retire? And it's like, I have no idea. Mm-hmm. What are you spending? What's your lifestyle going to be like? Wade's laughing. He probably knows himself. It's the same problem in that regard.
So as tough as it is to act in a fiduciary capacity, investors really have to take it on themselves to be forthcoming and honest, because you can only do your job if you have all of the material at your disposal. So what other key risks do retirees face?
Well, there's really a lot of risks. A lot of the risks relate to just unexpected expenses. But as Irv is saying, first you really have to have a sense of what your baseline budget is, mm-hmm. if you don't have these additional types of expenses. And then you just have to build a strategy with the risks in mind of how long you may live. You have to really plan to live beyond your life expectancy. Now, there's a question about how long you should plan for, whether that's age 90 or 95 or 100, but that's the key risk you're dealing with. And then it's all the market-related risks, changing interest rates, changes in public policy, changes in tax rules, changes just market volatility, right. And the sequence of returns risk with the order that the market returns happen.
So, Irv, what would be a financial goal when you're looking at retirement planning? Is there a specific dollar amount, or is it more than just dollars that you're looking at?
It's lifestyle. I mean, you got to start with that, because a lot of people, they'll ask you, how much money can I take in retirement? It's like, well, what do you need? I mean, what's the point of giving them more money than what they need, or what's the point of giving them less money than what they need? You need to really get a focal point on the amount of money that they need to spend, and try to target that. A lot of it's education. Obviously, I'm a graduate of American College, CHFC, and CLU, and a number of other things. I had to take his tests, so not fun. But again, through that education, you need to educate the client. So the goal is education. The goal is responsibility relative to their spending habits and things like that. And the other goal is managing that, because if you can visualize if people can visualize what they're spending, maybe they can control better. They can see, okay, I really don't need this. I'm not going to use this in retirement.
Right. So let's talk about the 4% rule. Mm-hmm. Tell us about that.
Well, the 4%, it's a rule of thumb developed in the 1990s to explain how much you can spend from an investment portfolio in retirement. a financial planner, Bill Bingen, was correcting a major problem where if people just say historically the stock market gives you 7% after inflation, people are talking about that being a safe spending rate. Every year the portfolio grows 7%, you could take 7% out. And that's just simply wrong. Market volatility, sequence of returns risk. That's what Bill Bingen was focused on, looking at the US historical data to say over any historical 30-year period, the worst case we experienced was you could take 4% out at the start of retirement, and that gives you a budget that you could then sustain with inflation for the next 30 years.
Right. So let's talk about this because it was a big topic of conversation last week where 401k investing, they might bring that all the way down to $2,400, right? Now, personally, that's something I would not like to see, but you could get that within a couple of months, right? And for a lot of people who don't have kids or don't have mortgages to write off or any other tax benefits, this is your tax benefit. So as much as it would impact me, or what are your thoughts on impacting the overall market and then what you do for a business?
I think it'd be terrible. I mean, I think it'd be short-sighted and terrible because unfortunately, if you don't incent people to save, they're not inclined to do it. You know, people are very short-term thinkers. They're not thinking about retirement. They're not thinking about longevity. They're not thinking about down the road. If you can gratify them instantly, which is what people look for in the market or whatever, and say, okay, you get a tax deduction if you put this money away for yourself, it unfortunately takes that. And I think it would be a huge mistake. As far as my business, a lot of the business is retirement planning. We have 401k platforms. We have defined benefit plans. We have a lot of that. So I think it would affect that, but I'm more concerned about what it would do to the actual investor. I think it'd be a problem. They wouldn't have the money, and I think, unfortunately, the government would have to step in at some point because if they don't have the money, they're going to have to support them through advanced Social Security or something like that. You know, I think it's short-sighted in general.
And would you agree, if you're not incentivized to invest, it's not, many people are not going to have the onus to do it. And
yeah, I mean, the 4% rule, I have a lot of concerns about that it may be too aggressive, but it requires you at least saving 25 times what you plan to spend. And the big movement over the past 15 years has been auto-enrollment and auto-escalation and just using people's inertia to get them into their 401ks. And if you lower the limit on 401k contributions, due to that inertia, due to people not paying attention to it, they're going to be saving less. And $2,400 a year is not enough to be able to manage the 4% rule at a reasonable amount of spending.
And you wonder what it does to the market overall, because you've seen so much activity in ETFs and in mutual funds because you have all this money that naturally has to be invested.
Right.
So it makes me wonder, okay, well, what would happen to the markets overall? But I mean, I just can't imagine that only $2,400 is where your incentive goes. No one gets pensions anymore. Social Security certainly is not going to cover it. So, and I think now, if you want to shine a positive light on it, now is the time to really start talking about retirement planning because you have to personally take it on yourself.
For sure. I think we're going to have to go to work again, educate people that if they don't take responsibility, no matter what the tax laws are, they're going to have a problem. And it's about lifestyle. It's about dignity of retirement. I mean, you don't want to work and slave all your life and then just live a pretty poor lifestyle in retirement and really have nothing to convey on to beneficiaries. I think it's a sad situation.
Right. So wait, let's say you're making $100,000, which is fantastic for anyone coming out of school or whatever point in your life. What would be the recommended rate if you have to think about these things on your own? What would you suggest to put away pre or post-tax dollars?
Right. So really the focus there, it depends on when you get started. And every 10 years you wait, the savings rate doubles. But if you're getting started in your 20s, maybe around 10% a year, by your mid-30s, 15% a year. As you get into your 40s, you're looking more at perhaps 30% of your salary to save each year.
And it just gets harder
if
you
the
don't
longer
start
you wait.
early. Even if it's 2%, whatever it is, it's still better than zero.
For sure, yeah.
All right. Well, thank you very much for joining us at MarketSite. And traders, as always, thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.